I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers Podcast Show, and today is October 26th.
We've got some good news, but how can this headline be good news?
That's right. How can a recession actually be good news here in the market for us? And we're going to go right into that because we've been reading the financial news like crazy. For all those who are in the real estate market, whether you're a homeowner, a home buyer, a real estate agent, or a mortgage professional like us, everything is, we're reading everything.
Yeah, and basically what you're looking for is inflation numbers and also the bond. Like that's it. Inflation bond, like ketchup mustard. Those are the two things, and I don't think I've ever paid attention this much to that.
So we're going to go right into, before we do into that, we're going to go into 30-year fixed interest rates. We see at 7.98% today. The 15-year fix we see at 7.29.
The 30-year FHA 7.38. The 30-year VA 7.39. Again, VA and FHA very, very close.
So these are really at the highest rates that we've been quoting over the last year and a half. So again, we're right about 8% for that 30-year fix. And this is according to the Mortgage News Daily, which is doing a survey of all these interest rates from the banks. It's not our rates.
Right. Yep. So this baseline is kind of a countrywide, survey of all rates. And this is what the average is. I literally just quoted a rate like 4 minutes ago before I jumped on here, 7.625 for a typical purchase, 750,000 with 10% down.
Yeah.
So that just tells you the difference.
So, but rates are high. You can see right here, the 10-year yield is what most investors are looking at. And I say investors, most of the stock market investors and
the bond traders
all throughout the world, they're looking at a 10-year yield, which is almost 5%. It was over 5% a couple of days ago. So 4.95%. All this means, if you look at this chart, it's just jet rocket. It's a jet rocket from 2022 up to today. And it happened so quickly. I'm sorry, that's not
that chart makes it.
This is 2020.
Okay.
Yeah, this is March 2020 to today. We've gone from the very bottom. This was a 0.5% on the 10-year yield and goes all the way up. It happens so fast.
And we talked about this, I think, in the last podcast. What we've done in the last, 2.5 years, took us, almost, 12 years to do.
Yes, exactly.
So incredible. 500%, delta in movement.
That's right. So the rates are obviously high. We're going to show that here because this has everything to do with why is this fourth quarter, if we're going to go into recession in the fourth quarter, why is that good news? We're still going to get to that point. We're kind of building the case here. The prime rate we see at 8.5%. Prime rate is what drives the credit cards, the home equity lines of credit, and consumer loans. It's basically things that a consumer, you or I, are spending to buy things. And it's not on the home, not on a mortgage, even though it's basically most of it's discretionary spending, and also car loans are affected as well. And car loans, and again, I was going to go back to the prime rate. Prime rate is what is the big driver, and that is directly affected by the Fed rate. So it is really close to an all-time high, or, in the last, in the last 12 years as well. And so we're used to a very low prime rate that is very high at this moment. Car loans, we see, this is from NerdWallet. If you have excellent credit, I was a little surprised. I was hearing on the radio that all car loans right now, the average car loan is like 13, 12%. It's really not that true. You can't, according to this resource, if you have excellent credit, above 780, you're getting about a 7% interest rate. If you have between 660 and 780, you're getting about 9%. That's probably where most people are.
And we're talking about the used cars right now.
Oh, yeah, used cars.
Versus the new cars. I didn't actually know that there was a difference. But I guess when you think about it long enough, there could be a delta for condition of car.
Yeah, and I'm just going to focus on the used car because what I do here in my next slide is I show the payments based off of what that would look like. But basically, most people are between 660 and 780. And very few people are going to be above 780, but so maybe it is around 9% is the average car loan right now. But you can see 13% if you have a less than 660. 21%. I don't know. It's so rare to find someone really in that 300 to 500 range.
Yeah,
but
that would probably be for a used car with a purchase price of like $5,000.
Yeah.
I mean, you just couldn't afford much at 21% interest.
Now, I just took these payments, simple amortization over 6 years, a 6-year loan, estimated payments on a $45,000 loan.
Okay, so a pretty good car. That's a pretty nice used car.
And it seems like today there's so many, car prices are high. It's just really inflated. So we see a car payment with this rate. You can see that's the person with excellent credit would be maybe $769.
Yeah. Okay, and why are we talking about car payments right now?
Because we're talking about what the consumer is paying. Like there is so much debt that's been accumulating, and the interest rates are driving it, like what people can actually afford.
Yeah, how much money is left over after they're buying their cars and they're paying for utilities and they're buying groceries and they're paying for stuff that's still inflated. They're not able to buy that much more, so it's going to start affecting the economy, which goes back to our first slide. Things are going to start slowing down, but don't be afraid. It's not terrible news. It is good news because it is bad news, and Ed, try and explain that.
That's right. So Yahoo Finance has this article about Bill Gross. Bill Gross is the former chief investment officer for PIMCO, which is a big mutual fund. He was very popular in the 90s, and he came out recently in a tweet yesterday saying that he believes that there will be a recession in the fourth quarter. He believes that the bond market is topped out. The yields have topped out.
Which is, these high interest rates have topped out.
That's right.
So that it sounds bad, but it's good.
So now I think it's really, really hard to, here's another I'm pointing to this with this red arrow, the recession in fourth quarter, but basically actually subprime borrowers have fallen behind on car payments in the last 60 days. He mentions that this is Bill Gross. And he said that when he tracks the recession indicators, this is a big one. Okay. Consumers cannot afford the high consumer interest rates anymore.
What are the big costs?
Yeah.
Home, car, credit cards.
Yes.
Like that's it. So if you are not able to make a payment on one of your big three, a car, that's going to tell you a lot.
Yeah, he does say he previously highlighted this is from Yahoo Finance. Bill Gross has previously highlighted skepticism on the Fed's ability and willingness to lower interest rates quickly. So they'll be slow to lower the rates, but he believes that they've pretty much stopped, and they'll be slow to react, and a recession will happen.
Okay, so and we've heard a lot of that too in this language, in that it's going to be higher for longer. It doesn't necessarily mean higher interest rates for longer, but it could mean current high rates for longer, which is fine.
Yeah,
we're really just not wanting them to increase anymore. We'll take the little bit longer interest rates so that inflation can come down, so we can finally get rid of this inflation issue.
So another billionaire investor, Bill Ackman, also yesterday came out and said the strategy he's been betting short. And in other words, he's believed over the last year that the interest rates are going to go up, and they have. He now believes that is over. He believes that we've kind of reached that point where it's greater risk that the yields were going to come down.
Okay, so
because of the slowing economy.
So in other words, a very smart guy was betting for many, many months that interest rates were going to go up, and they did, and he made a lot of money.
Yep.
That same guy is now saying he's done betting on them going up.
That's right.
So that tells us a lot.
So we can talk about this briefly here, is why is a potential recession good news? The answer is simply because interest rates are likely at the top. For those of you who own a home, want to purchase another house, want to get financing could be coming down. The interest rates could be coming down soon. And I think that's the entire purpose.
Yep.
Or that's the entire reason why a fourth quarter recession, could be good news for all of us. A lot of people might be asking, how is a recession a good thing? I mean, I know that we've just said that interest rates are going to come down, but why? I mean, they're like, why is that? Is that still okay? That could be okay with everybody if we have a recession?
Because the answer is, inflation feeds off of a healthy market. We need the market to slow down a little bit so that the inflation can't eat anymore. It needs to stop eating and slow the heck down, get back down to that 2% target range is where, where the Feds want it to.
Yeah.
So the recession is basically going to help get inflation under control.
Okay, so we're right here in Phoenix, Arizona. So at Maricopa County is where we do a lot of our mortgage business, or most of our mortgage business. So if you're in the real estate market, you're a real estate agent, you know these numbers. Some of you as homeowners, I'm going to show you right now, the monthly median sales price is $439,000. Why is that important? I mean, like, prices have gone up, they've inflated. If we go into a recession, what could happen with these, with prices? I'm going to show you something else first before we actually talk about that, because this is recent right now, 439,000. We've seen this big run up over these last couple of years. Active listings are 13,300, still pretty low. It's gone up.
But they've gone up. When's the last time we said that they've gone up?
They've gone up. I can tell you right now that, what's going to happen if we have a recession. Maybe we're the inventory is going to go up.
Yeah, and what we talked about is we want the inventory to go up, but actually the most desirable way to make the inventory go up is if interest rates come down, so that people that have been financially locked in their homes finally say, "Hey, honey, let's think about moving."
Absolutely.
I mean, that is the type of inventory movement we want to see.
So this is what we're watching really closely: the trustee deeds by the month. So are people going into foreclosure right now? The answer is no. We're at really all-time lows in trustee sales. So once again, we have low. If this starts going up, if we see trustee sales, which are like the notices of being late on your mortgage for more than 90 days, we're going to see houses go on the market. So we're going to see this inventory increase. We're probably going to see the house prices either stabilize, maybe even go down, or not. They may not be affected too much.
Right. We're really hoping that they just kind of stay stable. But
yeah, and I think that there's so much pent up demand for people that are currently in their homes, as you were just saying.
And they've been in their homes for how long?
They've been trapped in.
They're like, I got fever in my house. I got to get out of here.
Yeah, they've been trapped in their homes ever since before COVID. They have these low interest rates from the 2s and 3%. When they refinance, there will be a lot of pent up demand and a lot of this next generation. I mean, Gen Z. I mean, they can't right now. We just need the market's going to be much healthier if we don't have massive appreciation. We need to slow down the appreciation.
Yeah.
Increase the inventory.
Reasonable. We just need reasonable appreciation.
Yeah, and then make the housing more affordable in the payments. I think this is very, very likely something that can happen if we have a recession. So I think a recession is something that could help kind of cater and bring more health to the real estate market.
Yeah.
Just want to show you the contract ratio map. This is basically the map as of October 21st on the Cronford report, showing that the hottest markets right now are Chandler 85226, that zip code, Mesa 85201, and Gilbert 85297. And then Phoenix has the 85053, 85033. And then El Mirage 85379. So there are a couple zip codes that are in the hot market, but most of it's actually pretty balanced.
Man, do we have any what the freak?
Yeah, no, yeah.
I'm still shocked that the Cronford report actually has such a technical term.
That's right.
I mean, what the freak? Okay, so I think the answer is we don't have any what the freaks on here.
Everything's much more balanced than it was just months ago. So if you like what Tom and I are doing here as mortgage brokers right here in the Valley, we do this weekly. We really try to give you the best information that's timely, kind of breaking it all down. Be sure to subscribe, comment, and like, send us an email, or just call us.
Or give us a call. We'd be glad to help.
Take care, everybody.
All right. Thank you, folks.
Thank you for watching the Mortgage Brothers podcast. If you have any questions, email us at team@azmortgagebrothers.com. And if you like this content, be sure to like, comment, and subscribe to the Mortgage Brothers team.